Good evening, everyone, and a very warm welcome to the AWIF Women in Asset Management webinar. My name is Labkhan Kumalo, and we are truly excited to have you all joining us today. And we are looking forward to what promises to be a highly engaging, insightful, and inspiring conversation. AWIF serves as the women's pillar of ABSIP, which is the Association of Black Securities and Investment Professionals. And we are all about empowering, developing, and elevating women in the financial service industry. And this year is especially meaningful as we celebrate 20 years of AWIF, 2 decades of building a powerful pipeline of female leaders through learning, mentorship, and meaningful industry networking. Now, today's conversation is a powerful one. We will be unpacking value creation in uncertain times. We all know uncertainty is the one constant in today's world. Markets are shifting, pressures are rising, and expectations are evolving. But within that uncertainty lies opportunity. Our speakers bring an incredible depth of knowledge, expertise, credentials, and industry experience across the asset management landscape. But beyond the markets and the investment strategies, we'll also get the opportunity to hear the personal stories behind these accomplished leaders and learn more about their journeys. Now, to introduce our incredible panel. Our first panelist is Faith Muramba. She is the head of credit solutions and senior portfolio manager at Taquanta Asset Management, which is a cash management and fixed income specialist. Our second speaker is Lillian Bernard. She is the CEO at Matope Investment Managers, a listed and direct property fund. And our third speaker is Wafika Lacherdin. She is the head of debt capital markets at Future Growth Asset Management, which is a specialist fixed interest and developmental impact investment company. And it is now my pleasure to introduce our amazing moderator, Mbali Mutanyani, the chairperson of AWIF, a strategist and corporate treasurer. Mbali, over to you.
Oh, thank you, Lohan. Good evening, everybody. I hope I am audible. Please, can you give me a thumbs up in the chat if everyone can hear me? And then please, can I ask that my speakers, Wafika, as well as Lydian, as well as Faith, if you can just switch on your cameras for us, and we can jump straight to it. Hey, Faith, Wafika, and Lillian.
Hi, good evening.
Okay. Good evening.
Hello.
I was just checking if you're on.
Good evening.
Lydian is also on. Everyone is on. Are we good to go?
Yes, let's
Oh,
do it.
I'm just not seeing your faces on my screen, and that's why I'm starting to panic. But nonetheless, good evening, and thank you everyone for joining us. It's such a pleasure to host this. This has really been a work of art in terms of the AWIF committee, in terms of putting it together. I think we also we're talking about, everyone is really talking about these subjects and about uncertainty, and we haven't really had something that is really timely, and we thought it is time. So thank you so much for making the time and welcome. In terms of, I suppose, from an introductory perspective, I mean, the world as we know it is literally turned upside down. That's now my point of view. From a South African perspective, we have the upcoming municipal elections. What I'd like to call the beauty contest has started. We are seeing a lot of things on the news. We are seeing a lot of action in leading up to November. But I suppose it's going to be one of those ones where it's going to be the real test, really, for the GNU and whether it stands the test of time, which I suppose from a sentiment perspective, has something that has really been positive for us. I mean, we saw it with the S&P rating and the sentiment as well as the outlook now recently, which has been upgraded to stable. From a monetary policy perspective, the SARB as well as Treasury have come into agreement, and now this is policy around inflation targeting. The Middle East conflict, I think it was 84 or 85 days last time I checked, the largest supply shock in history, which has rocked energy markets. Obviously, from a coal perspective, everyone has run back to coal, and I think there's some level of pragmatism or ESG pragmatism, which we'll also touch on in terms of this webinar. The geopolitical tensions keep rising. And we know what happened when the big, beautiful bill was announced and all these tariff and policies were signed into law. What that did to commodity markets, to exchange rates, and the world now as we know it. 3 last points in terms of just high level, in terms of what we're working on. It's sovereignty is under threat. Last year, we saw the biggest election poll. 54% of the world went into polls. And I think from a policy perspective, we were expecting some changes, considering what happened in Botswana, if I can just highlight but a few. So there were a couple of glimmers, I suppose, not necessarily glimmers, but some indications that there would be policy changes, but not to this extent. So sovereignty is really under threat, and we obviously see this from a world that was open and is now starting to get more and more closed, obviously influenced by other measures as well. It's not something that's happening in isolation. And then last 2 is the Gini coefficient. I think throughout the world, as well as in SA, we have the highest Gini coefficient. So whenever you ask, someone says, what are you feeling? What's going on in terms of what's going on in South Africa? It's one of those where it depends who you ask. Someone who's in the middle class will have a different answer. Someone who's right at the top end will have a different answer. And the people that are in the lower LSMs will have a different answer because we experience it very differently. And lastly, I think the glimmers were quite positive when we went into this year, until obviously what happened in February up to where we have it now. So this is really just the backdrop of what we are dealing with in terms of just broaching and having this conversation with you, Lillian, Wafika, as well as Faith. I would ask you, in terms of this backdrop, if you could just in a few bullet points, 2 or 3, just say how you have experienced it in terms of what you do every day and what your views are, especially in light of the theme we have today. I'll start off with you, Lillian, and then Faith, and then Wafika, you'll close us off.
Well, Mbali, thank you for that very eloquent introduction to the world that we live in today. And thank you, everyone, for the opportunity to speak to you today. It's a great honor and a privilege to do so. So, yeah, the world, we were just, I think I must just sort of take a step back and fill everybody in. I look specifically at real estate and listed property. So it can be a narrow lens compared to the conversations that the other portfolio managers will have. But yeah, so we came out of a very tough period, as you all know, from COVID, and it took a long time for listed property to recover. And then we had the GNU and all the positive aspects out of that, a better currency, good economic growth projections finally, well, not good, but a lot better than it were in the past coming through. And as you said, we were all poised for all guns blazing this year. And then we had the Iran war. So after all the uncertainty and the terrible shocks, this was just yet another to deal with. And obviously for us in the real estate sector, it impacts inflation, which can be a good and a bad thing. And the bad thing, as we've just had this afternoon, is to curb inflation so interest rates go up. And so, you know, your outlook gets a bit dampened. But I think throughout all of this, I think what has become very clear to us, certainly as, you know, when you manage portfolios, is South Africa is actually in a lot better space than it was a good couple of years ago. And so whilst the rest of the world is got that trials and tribulations still coming, we just need to buckle down and do what we're supposed to do, and our economic growth should recover a bit, or be a bit stronger than it has been in the last few years. So I see this. It's not nice. You know, the thought of people being displaced out of their homes and being bombed every day, the stress that the Ukrainians, the Lebanese, the Gazans, the Iranians are going through is just too awful. But, you know, yeah, we need all of those resolved. And from a South African point of view, we just need to knuckle down and get on with things. And yeah, things will be better for our country and for our economics and obviously our markets.
Yeah.
Want to end there? Let someone else take over.
Thanks, Lillian. Thanks for sharing your thoughts. Wafika, from a debt capital markets perspective, any high-level views as we kickstart the conversation?
Thanks, Mbali. Yeah, so just for some context, I look at the debt capital market sector in South Africa. So those are typically your large cap issuers that raise funding in the debt capital markets. And I think maybe it's worthwhile just mentioning, you know, we talk about markets very generally, but there are sort of these little pockets of opportunity, or rather pockets of resilience, you know, within this, you know, across the world. So yes, there's all this geopolitical tensions, and it has inflationary impacts, and, you know, consumer spending will be impacted, et cetera. But I mean, when you're looking at investments, you have to kind of, you know, look through all the noise and all this, identify the risks. They are very real risks. But then at the same time, you know, when you're looking at companies to invest in, regardless of sector, you have to understand the resilience that each company has and the moat that it's sort of built around it. So these risks, they're very volatile. You know, markets change all the time. There's always something or the other coming at us. And that's why it's really important then to sort of look at fundamentally where the resilience sits and where we can find opportunities within the noise.
I love that. Love the finding opportunities within the noise. And thank you for those thoughts. Faith, over to you.
Thanks. Yeah, I think Wafika's summarized it really well. So for background, I watch over credit at Taquanta Asset Managers. So this is investment grade as well as high yield credit, listed and unlisted. So it gives us the opportunity to look at both large and small business opportunities. And like Wafika said, you have to look through the noise. I think COVID forced a discipline on us not to panic, because, you know, the businesses we had then, you know, before COVID made it through the crisis, got to this side. So even when we speak to our underlying issuers, you know, they'll say it is tense. It's interesting. They'll say it's tense. You know, it's bad. They'll point to the higher fuel prices. They'll point to, say, in agri, they'll point to higher fertilizer prices that are expected. But at the same time, they'll say it's not as bad as it was with Ukraine. So these are people who have almost weathered an even worse storm until now. They're very proactive. So yes, you look through the noise, but I think these are the times when process, management quality, the modes, like Wafika says, really come to shine. And that's what you engage in. You know, that's what you try to frequently get data on, and then from there try to make consistent decisions. So it is a very volatile environment. You have to watch what you say about any sort of predictions in this at this time. But ultimately, I think fundamentals and process is key to getting through anything like this.
You're reminding me now to your last point. I think it was rule of this week. He was just sharing, to say, if you ask an economist or any scientist if your head is in the fridge and your feet are in the oven, and on average, you're doing fine. So we just never know what we are going to wake up to. But average body temperature, you're good. Yet your head is in the freezer and your feet are in the oven. All right. So I wanted to just tell everybody on the call that we will be taking questions towards the end. We'll leave enough time for questions. So if you have questions, please post them in the chat. So perhaps in terms of, we've just given general views. I just thought it would be a great time to perhaps go into your individual, I suppose, roles. We have a broad, I suppose, from a participation perspective of the people that have dialed in. We have students on the line. We also have very young professionals on the line, as well as obviously a couple of senior professionals that have been in the financial services space for quite some time. And perhaps in terms of asset management, if you can just at least also draw some of those things, what's important for you in the role that you are in. I know we always speak about value creation, but it means something that's completely different for someone that's in credit versus someone that looks after DCM, versus, I'm going to pick on you now, Lillian, in your capacity as CEO, what that looks like. So if you don't mind going into your role, what it is that you do, and what's important, as well as the concept of value creation. How do you think about it in your everyday, in any order, please?
Okay, so thank you. I'm CEO of a small business, and because we're small, we'll end up doing a lot of things that you wouldn't do if you worked in a corporate. So my day-to-day stuff is it can move from the governance side to compliance to the admin to portfolio management to the research. So all aspects, and my team is very engaged in all aspects of the business, so that if I'm not there, it carries on. And so it's a full day, it's an intense day, and it takes you into different directions. But it's what I'm used to now. So it, from being an analyst many years ago, a portfolio manager, to head of property at Old Mutual. This is a sea change, but it's fun because it's our own small business where we can craft and create, where we see opportunity. So yeah, value creation is, I think, for us, because we in real estate are real assets. And I'm particularly sensitive to, and I don't know if I'll stand on anyone's toes here, but I'm particularly sensitive to, using, for example, hedge funds where they short sell to try and make money, as opposed to investing in a startup. For me, the investment in a startup is the value creation, where you create jobs, create income, pay your taxes, grow the economy. That for me is the value creation. And yeah, versus the other side where you're managing portfolios, trying to find something that's undervalued at the time, where you see good opportunities in terms of the income growth, but it's not properly priced. Clearly that would be a value creation. So it's a little bit of I suppose, as again, because it's real estate, you can straddle both. But I like to see construction. I like to see infrastructure projects off the ground, because to me, that's the fundamental value creation for the economy, for stock markets, for people's pension funds. So I'll leave that.
Thank you so much.
Yeah, I'm happy to go next.
Thank you.
Sort of a slightly different angle around value creation, and just in terms of the asset class, which is credit, right? So in equity markets, one would consider value creation, in terms of, share prices increasing and dividends and the like. So if you have an equity lens, you're looking at upside potential, right? Whereas when you in the credit space, and you effectively just lending money to a corporate or an issuer, the only amount that you can get back is your interest and your principal, right? So there's no like upside from that. You're more managing downside risk. So you have to like fundamentally you need to be comfortable that the company will repay you in full and on time. So if you look as an investor, you would allocate your capital like just generally across different asset classes. Your equity would be, sort of your high risk, high return space, and your allocation to debt or credit or like sort of money market type space. That's where you'd park your allocation to low risk, for example, right? So when you're in the debt capital markets, so like what my team manages is sort of your investment grade corporate. So there you'd want to make sure that, from a fundamental basis, that you have a strong view that these guys will repay you in full and on time. So the value creation is more about managing risk and reward. So the riskier the counterparty, the more you expect in terms of the interest rate that you would charge. And the way that it works is that that's the max that you can get. But there is some trading that could happen in the listed space. And the way that you generate alpha is not just by going the most riskiest and getting the highest interest rate or credit spread. You'd want to just manage that. So value creation in the context of credit, I would say is more about balancing the risk and reward. Yeah, I would answer it in that sort of sense.
Perfect. Thank you. And your perspective there?
I mean, everything that Wafika said on the portfolio management side, I mean, I'm also firmly focused on credit is true. So I'll focus on a different aspect, which is more like a stakeholder view. So we are a cash house and then a fixed income house as well. But I think we are unique in the market as to Quanta as having a very big cash book. And cash might sound boring to some, but I've never seen a more invested client as one you find in cash, right? They are constantly moving money in and out. They're watching the markets. They'll know when there's a rate hike before you do. They're very sensitive if their product pays less than what the banks will provide. And then on top of that is liquidity. So if you then are providing a solution that helps the chief financial officer, the financial director, to provide a higher income for his balance sheet, at the same time not compromise his access to liquidity, his or her, sorry, I need to remember the platform I'm on. His or her
we have very capable tables.
His or her access to liquidity. It's such a rewarding experience when you're in there and you realize that, by outperforming by 10 basis points, 20 basis points, it might sound like a small number, but when applied to billions and it's going straight to the bottom line, right? This is a balance here. I mean, often people think about unit trust, right? Or something of the sort, and then you're dealing in percentages and these things can seem tiny. But when you are able to give someone 20 basis points more, or a whole % more than they would have gotten from their banker, right, by coming into a certain product, and they still could move their money around, they could get that liquidity. You could be adding an additional R1 million, 2 million Rand to their, bottom line, which they wouldn't have had otherwise. And then to have someone to converse with, to discuss market information, rates, FX, etc., I found to be a very rewarding position. So, sorry, there seem to be issues with the sound. I'm just checking. There's just a few messages where someone seems to be complaining about sound.
So I just hold on, Faith. I can just stop you there. I just want you to see if it's in general, everyone has the same issue. It's just one or two. Okay. It looks like I see Pamela, Skosana, and shit. It's fine on my side. So if the guys that don't have sound, if you can just leave the call and rejoin. Thank you very much. Apologies, Faith.
Okay, cool. So value creation for me, I think is just to add to what everybody said, is also on the client end. where you truly can provide solutions that affect the day-to-day running of a business, and then ultimately affect their bottom line, give them a little extra income from the cash they have on hand than they would otherwise have had. And then this applies to all products, right? If you provide a better return for the pension funds, if you provide a better return for medical schemes, it will help with the pricing of the premium in the next year if they have a high surplus, right? So the outcomes of investments have a knock-on effect, so to speak, on the budgets of everybody else down the line.
And thank you so much for sharing the perspective, especially around returns as well. What I wanted to find out is, and anyone can take this one, is obviously if I'm looking at a portfolio management, there obviously is a lot of competition, and obviously the way I'm going to get value, and I'm looking at it from a perspective of just me and where I want to put money in, or the end user, where I want to put my hard-earned money in, the element of returns, or just how much you would make, what you were just saying now, Faye, around the difference and what it means actually from a cash perspective, and why that's important. In the current context, how should we, from a strategy perspective and how you've managed your portfolio management, how do you adjust considering the amount of uncertainty that's currently in the markets? And literally, if I just take a look at the oil price, you wake up one day, the peace deal is on, and then all of a sudden there's just been, another event that went against what was agreed in terms of the deal, as one example. And I'm sure there's other many examples. All I'm just trying to say is that there is, in terms of this environment, but there's just so much uncertainty. What strategies do you use to ensure that you still protect, I suppose, funds or assets, but also be able to diversify enough to ensure that the portfolio is robust and is still able to create the value that's expected? And I asked this because I was listening to another webinar last week from another asset house, and the conversation was really around impactful diversification. And they were using analogies around the fact that you really need to adjust as you go. And another bank strategy in terms of where we are around uncertainty, they have this theme around you really have to think about the cycle end to end and manage through it, but obviously you need to adjust as you go. So I was just wondering, in the asset management space, and especially where you guys are, in particular in your spaces, how do you strategize for this uncertainty to ensure that we still get the performance that I suppose the end users, clients are expecting ultimately? And in any order, please.
Key question that you've hit the nail on the head. So if I can take it, first round, I mean, obviously for us, the work that we do, it's fundamental bottom-up research on each of the property companies in our universe. And when you're looking at an outcome in the portfolio, and it's a very uncertain time where you can't expect perhaps your capital growth to be reflected like you would like, then it really boils down to the income that's generated from these property portfolios and the underlying listed property vehicles, that is. And like you say, with this changing environment, there's a lot of changes that happens that needs to filter back into your models. For example, higher interest rates, higher inflation, etc. Just to give two examples of that. And you look for the most robust company that's going to deliver on its earnings. In times when you're doing portfolio construction in current times, I mean, I'm very focused on making sure that I can deliver a good, strong income yield, because I think if I'm able to do that, then in time, the capital growth will follow. I can't dictate, when that will come through, but I can help ensure that the income comes through for pension fund holders, unit trust holders. But it really does start with literally, fundamental research. And in our case, it means going to visit the buildings, walking those pavements, seeing the assets, talking to people, and doing the modeling around the portfolios that are held in each of those listed property companies.
Thanks, Lydia.
I'm happy to go next. Yeah, I mean, 100% agree with Lillian, and Faith mentioned it a bit earlier as well, where you have to rely on your internal processes and sort of fundamental analysis where you look at each counterparty individually and understanding the risks, how they manage it, how they position in the market, what their competitive edge is, etc. So fundamental research does really it is sort of core. It's a very core principle in managing at least credit risk. I think for us, in terms of additional layers and how we manage it, is from an equity perspective, you're looking at a share price, right? And a share, it's a single instrument, right? Whereas in the credit space, you have a choice as the lender in terms of the tenor. Like, do you want to do a 1-year loan, a 3-year loan, a 5-year loan? You can play around with where you sit in the credit hierarchy, senior or subordinated debt, for example. So you can take a view on the counterparty and then decide sort of where you want to sit in its credit risk profile, like in terms of where you're comfortable to sit. And then also around the way we manage credit risk is around tactical allocation as well, in terms of, which sectors are maybe more resilient or more defensive. We'll limit the tenor, we'll limit the seniority. So there's different ways you can have a view on an issue and still within that, or a sector, and within that you can play around with managing credit risk and looking at it from a portfolio perspective, how you distribute that risk in the portfolio. So there's a lot of ways in which you can manage a credit portfolio, and you have quite a few different levers to pull to sort of position your portfolio depending on your outlook on the market.
Great, thank you. Thank you, views.
Yeah. So yeah, I think Lillian and Wafika have emphasized that fundamental analysis, hands-on, coal-face type analysis is critical. You have to know your assets, you have to know your borrower, you have to know your investment. So I think the thing for
research.
Yeah. Yes, exactly. The thing for me that over time has been clear, like I said, through COVID, through the different cycles, through the Ukraine war, through this shock now, is sometimes you don't have liquidity. And what I mean by that is you can't change your mind after the event. So you've invested the money, right? So you've made the decision, and now 2 years down the line, you have this stark change in the macros, right? February, we were looking at one thing, and by the end of March, it's different. So what do you do then, right? The asset has been bought in a different time. And there I found that, you almost need to select for the different scenarios before they even happen. So you need to try in the process to have good reasons why you hold a certain sector or a certain asset, and then identify the risks, like Wafika said, and then mitigate them. So that's the key part before they actually happen. So you are worried about interest rates, then you have to have the floating rate asset before the event. You're worried about a deterioration in cash flows, then you need a covenant that's set to, or you need to select a business that has a lot of cash flows to withstand a shock. You want to monitor it closer, so you need to put in a covenant to help when there is deterioration in those fundamentals, so you can step in and act quickly if you can. So all of those sorts of disciplines almost have to be in place. So when you select the asset, select the sector, construct the portfolio, you then have to have those range of scenarios in mind. Because it's one thing to pick an asset in this environment, but you probably are already 90-80% invested already.
Yeah.
And so those assets need to have been selected to withstand some sort of shock. And thinking like that then helps you get through the tough times a lot better. Because the thing is that I think for me, the biggest learning is that you have to understand the long-term history of how a similar asset or a similar sector has performed in the past. Only then can you try to look forward and try project those scenarios.
Yeah. So what I'm hearing is, from a risk management perspective, the theme of diversification is somewhat there. You also need to, what Lillian has said in terms of research, you really need to unpack, understand the data. From a real estate perspective, absolutely go and just check on the property itself. So I'm hearing lots of management strategies, and I just wonder at this point of the conversation, over time, we've obviously seen technological advancements, and the current, I think it's not even a current buzzword. I think it's been for the last 5 years, at least, AI, artificial intelligence. That it's a tool that's there to assist and to ensure that we make data-driven decisions, impactful decisions, but obviously the right decisions that are data backed, but obviously at like a fraction of the time. If I'm to think of any bots, if I go into any website and I ask if there isn't the call center agent involved, I just type in a few words, and then within a few seconds that shows up. And then there's also the different aspects or different views from people where they were saying, although technology aids in productivity or aids in efficiencies, however, there is this risk that it might just steal actual jobs. I suppose in the asset management space, the first question, and please in any order, is how are you using technology in your space to enhance, I suppose, be faster in terms of how you process information? Has it been helpful? And then the segue to that, and that can be somewhat different, is the importance of time. And by that, I mean, just being in the space over some time and understanding the cycles, which again would solidify what you know about a certain sector, or asset class, versus just using outright technology to select whatever stocks you need to pull in as and when in the makeup of your portfolio. So it's a twofold question. I'm happy that we first deal with are you in your current space using technology? Are you seeing that there's a much bigger uptake? And then the second one is, I suppose, from a responsibility perspective, the importance of gut and understanding the cycles and time.
I'm happy to go first.
Perfect. Thanks, Rebecca.
Yeah, so look, we like AI in a sense that, as you mentioned, it can make your job a lot quicker and faster. It can process information a lot quicker. But I think it's also important that there's guardrails in place on how we use AI, particularly sort of for the analysts. I mean, we don't want to replace analyst jobs with a bot. We think that human judgment is critical in investment decision making. So we're happy that AI is used in terms of, like pulling data, for example, and synthesizing like a lot of information in sort of a specific format, or in a summarized version or whatever. But not that it produces the report. So, for example, hey, I'm looking at company X, give the right market report. We don't necessarily agree with that, because we need human intervention in this as well, because there's risk to AI, right? AI can hallucinate.
Yeah.
Which is like we can't be making investment decisions based on like hallucinations. I mean, that's a no-go, right? Obviously.
Yeah, especially
but you
when
can
there's
use
like pension funds involved. I mean, those are people's life
it's high
savings.
risk.
Yeah.
And we work in big volumes, right? So in terms of like millions of rands, hundreds of millions and billions of rands that we invest on behalf of clients. So it's very risky to to simply have AI do the decision making, right? But you can, by all means, chat with AI in terms of like, help me analyze the working capital cycle for company X and how does it compare to its peers. You can chat about that if you're wanting to understand a particular concept in more detail. You can have AI help, get your mind around it, etc. But human intervention and human judgment is still very key in the process. I think additional risk is, for new analysts, or rather put it this way, like if AI comes up with an answer, as an experienced investment professional, you can kind of pick up like, okay, this doesn't sound up right, this looks a bit odd, and then you challenge it and they're like, oh yeah, sorry, you're right. Whereas obviously as a junior analyst, if you haven't built up that expertise, you can't necessarily spot that, right? So it's a challenge in terms of how we balance that. But certainly not looking to replace analysts with AI, but rather using it as a tool, as you would any other tool, but still have those guardrails in place.
Perfect. Thanks, Rafika.
Yeah.
Yes, you
I
want to
think
talk?
I think if I could pick up on that, we've been asking our own issuers, the underlying entities that we invest in, the same question, like what are you doing with AI? And I agree with Wafika, you can't remove the human aspect. But what is interesting is one of our it's a bigger entity in the market specifically said they have taken an active decision to no longer hire for capacity, only for ability. So what that means is if the constraint in the business is we need more people to do X, then they will essentially not resource for that. They will go out and see if they can get AI to essentially allow for more processing of whatever it is they need to be done more. But where they need more decisions, so quality decisions on something, then they have to resource for that. And it's subtle, but I think to Wafika's point, what you want more than ever is an experienced analyst, not someone who punches numbers. So it is a paradox that it is an environment where you're getting more information, but the most valuable person is the person who has the most experience already, because you could, if I could, yeah, exactly. If I could paraphrase it, I think the key to this tool is being able to ask the right question. And the way you can ask the right question is by knowing something or a lot of what's happened before, or else you're just staring at a black box. How you balance that in terms of incoming talent, I think people have to rethink like training, because you can't exactly hire someone to just punch things or copy paste things or read things, you can receive PDFs and read them, because it's not efficient. It doesn't make sense. So in my mind, how do you more like thoughtfully transfer the experiential knowledge of the seniors as opposed to the processing knowledge, which is how they came up? Because it doesn't make sense to hire for that anymore. But once you have hired someone, you probably want to have proper sessions of doing more like detailed sector review work, where someone who's experienced almost takes you through time and shares what they know about something, as opposed to, necessarily telling you how to assemble a report, because that can be done through technology.
Exactly. I mean, that's a very interesting perspective. I work in the mining industry, and we are seeing some of those around the mundane duties where you can be efficient. You then plug in a technological solution versus in a role where you really need the experience, and the experience is what makes the role. And especially if you think about it from a mining sense, I mean, any decision could, or any wrong decision could lead to a loss of life. So the stakes are quite high, right? Leland, I would appreciate your views here, especially around the facts. what you were saying in terms of doing the research, going to see the properties. I suppose from a technological perspective, I'm just thinking that's something we can't necessarily send a bot to do. How has technology influenced, especially in the REIT, in your experience, how you do things?
Okay, so definitely, I mean, technology, has played a huge role in improving how one manages portfolios and does the research. I mean, in the old days, you literally had your pen and a piece of paper and you worked it out by hand. When I started out, Lotus, which was the first kind of spreadsheet, and Excel soon replaced that. So it goes back a long time. So I'm very glad to hear that I still have a job with my experience. I can't
Still value
retire
you,
soon.
absolutely.
But so technology is sort of fundamental to what we do, because it means, as you say rightly, that it frees us up to do more important thinking. And obviously things have evolved. So today we use AI to speed up processes, to sort of do the more mundane manual stuff, daily functions, but most certainly do not use it in writing of reports. That's got to be done with a person. But things like making our presentations look nicer, definitely that's been helpful. So the sort of things that just help you look, more professional. Most definitely, we will use that. In terms of our research, we found you're able to access financial statements of companies globally now and just download it into a spreadsheet. That's rather nice. And then we also use mapping tools where we can map where real estate is. So for example, and I'm sure we'll touch on ESG, but the location of where properties are these days with flood zones, or you just want to know where they are located. That's quite nice to have that tool that you can quickly see from the various companies' portfolios. So I would say that it's not going to replace what we do. It will help our job, make it a bit easier. And unfortunately, we still have to get on the plane and go and see property. Although I have to say, and I'm sure everybody will remember before COVID, this Zoom and Teams that we use today, how that made a huge difference. We don't have to get on a plane and go and see people. But at the same time, there is no replacement for the one-on-one.
Absolutely.
So it's definitely had a huge impact on our roles as analysts, as interfacing with other businesses. But you can't get away from actually walking and pounding those streets, I'm afraid.
Absolutely. Thank you, ladies. And then I suppose you've also created this nice segue around ESG, Lillian, in your last point, around, the importance of location in terms of the property. But I'd like to use what I've just said in terms of what's in your world, Faye, and what's in your world, Wafika. A lot of sentiment, at least of late, has just really been around the pragmatism. We were going through a couple of years where I think we couldn't finish a sentence without saying ESG, or certain asset managers were really, if I'm thinking about it from asset managers who put money, I suppose, in equities. You wouldn't have an AGM without someone asking something that's around sustainability or impact. Is that still the case in terms of what you are seeing? What are some of the trends, I suppose, in your individual spaces that you'd like to highlight, or the one that actually stands out? So we have enough time, and I also leave enough time for questions.
So if I can kick off with real estate, it's actually hugely important. I mean, we've seen with our load shedding challenges and our water challenges, certainly down in the Cape about 7 years ago, and you are feeling it now. you have to be resilient to all of this. And, we were forced into becoming resilient because the supply wasn't there. Other parts of the world, they still have that luxury, but slowly, they're also feeling, that they have to make the changes. And if it's not coming through and happening sort of naturally, the government is changing laws to enforce change to become more sustainable. For example, in the UK, if you don't, retrofit your buildings to be more energy efficient, then you're not able to let out your property from a certain point. And so it becomes an imperative to spend the money to be sustainable. So in South Africa, it's been hard for us, but it's also, now starting to pay dividends. And you're seeing that benefit where a lot of all property companies have now spent money putting solar on roofs, putting batteries in as well. And, now it's focusing on water. That's all bringing in savings and cost savings, and obviously benefits the tenants. So you are seeing a return on that spend. But more importantly, you're seeing the resilience. And that's obviously the ESG element. But, even from a social aspect, if companies don't spend and take care of the people that surround their assets, in our case, it's real estate, then you saw the riots in KwaZulu-Natal and how properties were looted, etc. So there were buildings that weren't touched, and the property owners will tell you it's because we've involved the local community, and there's a lot to lose if these buildings get torched or damaged. And so that investment into a social compact with your community pays off handsomely. You can't see the money straight away, but in downtimes, boy, does it stand out that you've invested and you've worked on your social your social compact with local communities. So all of these things, you talk about it, and then of course governance. Have we seen failures of governance and how that impacts people's savings? You only have to look at Steinhoff,
Yes.
etc. So all of these things, whilst it looks like three letters, they actually have material impact on an outcome, an investment outcome, on returns, on the country's performance as on the economy. So it's really, those are sort of practical examples of those three letters, and then how it gets incorporated in terms of research, in terms of what value do you put on a company through a discount rate, where you apply a discount rate, which, by the way, as the years go by, more and more metrics get added to that discount factor. Becomes more and more complex with time. But, it must take in all of these things that we're experiencing, whether it's a geographic location or an ESG factor.
Wakif, I'd like for you to, and thank you for that, Lydian, I'd like for you to take a very different angle around, this is now the activist investor, just what you have seen from an ESG front, if there's something you'd like to share in this space, or suppose recent developments or what's trending.
Yeah. So maybe just in terms of ESG and responsible investment, maybe I just want to dive into sort of three different lenses. There's like an investor lens, there's an issuer level side to ESG, like in terms of a company level ESG, and then there's the client perspective, i.e. sort of like the pension funds, for example, as clients who actually, appoint asset managers to invest. So as an asset manager, one could look at responsible investing as, very high level, like, do you want to support gambling and tobacco companies and that sort of thing, in terms of, is it a net social good or bad, that you can have that sort of view. What we do in terms of sort of ESG analysis, and maybe for those on the call that don't know, but ESG is environmental, social, and governance factors, which is sort of your non-financial factors, right? So there we look at how the company is positioned on those three fronts. On the governance side, you want to see that is there enough, for example, independence on the board. How are do they have financial expertise on the audit committee? Like the King 3 stuff. Because in the end, the company the direction of the company and how it's operated is by people, right? And then you have to understand sort of, are they the right people they're managing the company? On the environmental side, it's do they have policies in place around how they assess climate risk, for example, climate risk in the way that they operate, as well as social factors. For example, if you're investing in the retail company, like what are the labor laws in the supplier countries? So there's ways, because in the end, those risks do manifest at some point, right? And it can impact your returns. And then what we've seen on the client side is that, clients are increasingly becoming, they want to see reporting on, for example, job creation, climate risk, emissions and things. So as asset managers, we need to have that data to report to our clients. So there is the sort of like a data heavy side to this, and monitoring and reporting. But to your point around responsible investors. So, as an asset manager or as an investor, you can identify risks for, talking the gum. You can identify all the risks, but then what do you do about it, right? You can either choose not to invest, or you can try and drive change some way or the other. So, and Future Growth is very vocal on this. Some might remember sort of our stance on SOEs, for example, when sort of the state capture, before state capture was actually sort of publicized, the analysts sort of recognized all these risks around poor management, poor governance, and sort of raised the alarm bells, and sort of made market announcements around the risks and sort of the stance on these SOEs. So you can as investors use your like as fiduciary duty, your responsibility to acting on behalf of clients and try and drive change. We are always writing, not always, but if there are risks that we're not happy with, we would write to management, we'll engage with management, we'll write letters to the ministers, and so it's because you can see, like, then the issuers need to know if they're up to no good, that we are watching, right, and that we are going to price for the risks, vote with, they call it vote with your feet, so you either stay away from the fundraising activities, or you price really high for the risks or whatever. So asset managers and investors do have a responsibility as well to try and drive change or call out where there's bad behavior.
Yeah. I like what you're saying around voting with your feet. I mean, it really hurts, especially if when you start voting with your feet, and the impact it has, especially on listed equities on the share price. And perhaps, Faith, if you could maybe share with us your perspectives around how, not necessarily from a reporting and how important it is, and the positives there is just on aspects of excess, and how, I suppose, sustainability or ESG has really opened up opportunity for, I suppose, businesses that wouldn't have had the opportunity to access capital, for example, without the ESG or sustainability umbrella.
Yeah. So, I mean, very, very quickly, just in-house, right? When we're looking at issuers, and we were going on our own sustainability journey, because it's evolving, it's constantly changing. We've been improving our questionnaires, our surveys to the issuers, and like prodding them. And I found that sometimes they themselves do not know the data that would enable them to tell a better story around sustainability. Often there's just this thought, oh, it's going to be expensive, I can't add another layer of costs, you're asking me all these irrelevant questions. Especially for smaller, businesses or entities, right? It's like, I've got, a whole lot of things to do that have to do with, the direct role or the investments or the return. And now suddenly, this asset manager has provided you funding, has sent you this long questionnaire asking you, about the underlying, like, your employees, your, if you're on lending, who you're on lending to, the demographics, if it's property, what have you built, in which segment is it in? And then that can feel like a lot. But what we found is those who actually engage and are willing to start tracking that data. And over time, I think that's key, is that it is supposed to evolve. It's not supposed to be perfect the first time around, especially for smaller businesses. We found that those who take on the challenge, right, At the extreme, we've had people who've completely changed their business model because they then identified an opportunity that they weren't necessarily paying attention to, and actually changed their model because they were assessing their borrowers with a different lens. And then for others, because they started reporting sustainability metrics, they opened themselves up to another type of investor for whom impact is high up on the scale. So they found that by telling a better story, they could access, a different type of funding, right? But we also find that in general, like in the market, right, something more visible would be the Cape Water Performance Bond. I hope I've gotten that right, issued by First Rand. And I think it's worthwhile going into it and digging and reading. It's the first nature-based bond, I think, in South Africa. Ultimately, this bond will enable more water to be produced at a fraction of the infrastructure. And you don't just get a return for the financing, you get a return if the underlying provider also manages to clear the alien plants that are harboring the rain from getting into the ground and essentially adding to the groundwater. But what's even more interesting is that the city of Cape Town is expecting more water and ultimately more tariffs and ultimately more revenue. So you have this situation where this investment is not only providing a benefit to investors, but it's also providing revenue to the municipality, and more than that, actually affecting people's day to day, because you've got more supply at a fraction of the cost you're going to get. So I think for me, it's understanding that these things can feel hard, they can feel unnecessary, they can feel like they're adding to the pressure, but you find that there are these amazing secondary effects in being able to communicate and being able to reach a different type of investor, in being able to provide, secondary benefits, positive, what do they call them? Positive economic impacts to the rest of society, over and above a financial return.
Yeah, and thanks for that. This part of the conversation, I want to segue into a little bit lightheartedness. I think when we read your titles, people already start having stories in their heads. I mean, like Lydian, for example, is CEO of Medupe Investment Managers, and I'm already like, oh my gosh, So we tend to dehumanize the person behind the title. So, for example, I mean, I also started Googling you, Lydian, in preparation for this webinar. You leave Old Mutual Asset Managers in 2002, and you awarded the management for a number of listed property mandates, which has led you to manage funds under a different license. You then go on to buy out the shareholders and rebrand the company, which is where Medupe Investment Managers is born. 14 years later, now, I mean, you've seen a lot. What do you know for sure? And firstly, in terms of in this space, in REIT, in keeping your cool, especially during uncertainty, you were speaking earlier about COVID and just how that not necessarily rocked the world, but it also, I think, to a large extent, also rocked the property market, right? So as an entrepreneur, you run a business, the bottom line is the bottom line. What would you say in terms of your journey that is, you've actually managed to keep you in business for this long? How do you do it? How do you show up every day and keep a business such as Medupe standing 14 years later?
Geez, what a question. Thank you, Mbali. Yeah, this COVID, geez, did I have to revisit everything I understood about real estate? I just launched an income fund and there was no income to be seen anywhere. The guys who ran the listed property companies rushed off to Treasury to say, please, can we not pay any dividends this year while we manage our potential corporate bond fallout, liquidity fallout, which obviously, it's Wafika's and Faith, your areas where liquidity is so important to real estate companies. And I had to go and run to Treasury myself and to the JSE and say, no, these are REITs. You've put rules in place. If you change the rules, there's no more industry. So it was a very trying time for everyone involved, both sides, you know, as being a shareholder and obviously the guys running these entities. And then doubly, you know, not only you're worrying about your poor old investors who've lost, I think, from peak to trough, and it was the peak was before COVID, so we had the fallout from Steinhoff falling into the real estate sector with I forgot, these hedge fund guys were trying to damage Resilient and Capitec at the same time. And so there was all of that drama. So from peak to trough, it was minus 70. Now, never in all my years, and I've been in investments a long time, a drawdown, on average, a bad drawdown would be minus 30, you know, and then it recovers fairly quickly.
Yeah.
And in this case, the recovery took 5 years. Now you try and run an asset management business where your income is severely impacted. And I have to say, how do we do this? Because it's a team effort. It's this phenomenal team that works with me, who are passionate, who lifted me up when I mean, it was such a major period to go through. And we had to redo our models, I don't know, about 5 times. Every time there was a different, but you know, when your lockdown, you had number 1 to 5. We had to change our models and rework all the numbers and work out which tenants were possibly opening in some, you know, which shopping centre, and so it went. So it was a very difficult and challenging period, and you know, I certainly reached out to all the suppliers and say, listen, our income's gone. You have to relook at your invoice. And do you know, every single person from the JSE to the auditor to the suppliers for technology, etc., everyone came to the party, and including poor old staff that, you know, had to take less, and some of us went without completely, and we got through this. So that is for me like serious grit and passion and dedication to what you do. And yeah, it's obviously a lot better, but you know, we don't have a big daddy. We're an independent, and we're women owned, and it's been a journey and a half. Would I choose to do it again? I don't need the stress. That was unbearable. But to work with the people that I do, most absolutely. It's just been a really interesting journey. Yeah. So that puts colour on. I don't think you speak to any other asset manager that will have the same experience as me. Because we just did real estate. You know, most asset managers have a balanced portfolio, and you've got different sectors pulling you through. But you know, we were hit like really hard, and so it is quite a story about resilience and grit to get through this. And obviously, our amazing clients, you know, they stuck by us as well. Yeah, because you know, each one has their own journey, and there were some clients that were also hard hit and had to rebalance and refocus. So yeah, we made it.
And very well done on your resilience and just managing to stay afloat, and also just getting good people in your team, especially in trying times. This is where you actually see who you have and who's in your corner. So very well done. Faith, you next in terms of your journey at Tankwata Asset Management. I hope I'm saying it right. I mean, you come in as a trainee portfolio manager, and you obviously get involved in credit and in high yield strategies. I think at some stage you're also a senior portfolio manager, and you were managing, I suppose, enhanced income and high yield offering, as well as the risk, as well as ESG valuation. I mean, it's when I read your profile, I'm like, okay, that's ESG valuation, okay, credit risk, enhanced yield, high yield offering, portfolio management. In terms of someone who looks at you, because I mean, your CV is just remarkable and very well done on what you've managed to accomplish thus far. If there's someone on the call that wants to get to where you are currently, what do you think has set you apart Was it also intentional? Were you lucky, if I put it like that? Because I felt like as I was reading through your CV, I could see you moving into different spaces. And I just don't know which portion of that was opportunity, or if it was a real intentional, calculative kind of decision. Can someone follow the same trend, or this was just you being faith and being fabulous at what you do?
That's very gracious. Thank you for that commentary. I don't know anyone who can say that they've done it on their own. I think this journey in any finance type of career, right, it requires more than anything mentors. People who are willing to share their time, share their experience, because that's really where you learn from. I didn't know much about credit. You start off in a more conservative space, and you have a certain mindset. So, like I said, liquidity is key. So, if you can't liquidate something, it's bad, right? And then you wear that hat because it serves a certain product. But with time, I got exposure to credit funds through just diversification of products. And I had a wonderful mentor who I just sort of hung around because I just liked the way he talked in meetings. And I wanted to just talk like him. Like there was nothing more.
I also had managers like that. Yeah.
You're just like, you hear them speak, you're like, I need to figure out how your brain works because I want to be able to talk the way you talk. I think the biggest part that I got out of the way that this particular mentor expressed themselves was they really cared about the underlying business. So you come from a world that focuses on liquidity, which is more about the instrument, right? Can you trade it? Can you sell it? Who else wants it? To a world where you're really focused on the underlying business, right? You got to know the people by name. You got to know what they're doing with the money. You got to know the business model. You got to know, does this thing have a net benefit? Is it exploiting anybody, right? And this real feeling that you are actually helping, right? So not just you're being extractive about the return, right? So I want this interest rate, pay me, but you really feel like you're a part of the process of how this business model gets executed, and that you're fundamental to the growth of this entity, to the sector, and then all the other knock-on effects. And that perspective was interesting. And this was before, we started getting all these sustainability, ESG type due diligences that we now get from our clients, where you now have to sort of articulate it through frameworks. This was really using it to sort of figure out risk, right? And really try and understand the business. And so in that journey, I would say the biggest thing was curiosity, I think. Whatever sparks your interest, whatever, feels true to you, and then you just lean into that. And where you can get access to try something, to test it, you do that. And the end part of that was that I was so moved, I went and did a master's in development finance, because now I really wanted to know like the knock-on effects, right, to the greater part of society in terms of investments. And then so started the sustainability journey. So I think that the key of it is curiosity, and then when you find that thing, or that person, there's so many sources now. It's a book, it's podcasts, it's, you have access to thought leadership in so many ways, right? It doesn't even have to be physical. It doesn't even have to be, on this continent. You have access to so many other things. So stay curious, find access to that knowledge, and then lean into whatever it is that makes you feel like you should keep going.
Yeah, and very well done on what you've managed to build thus far. I'm sure the future even looks more exciting. But what I got from that is the curiosity, and just the value of mentorship. So very well done. Wafika, I'll end off with you before I go to questions. You began your career in 2012 at Old Mutual. You completed your chartered or CA articles. then you were responsible for an analytical team, and then you then looked after group credit exposures across balance sheet as a credit portfolio managers, still at Old Mutual. Now, I mean, we come back and you are head of debt capital markets at Future Growth. How has all of those experiences shaped or contributed to how you show up as a person?
Yeah, that's deep. Yeah, so I mean, look, so I think it's a combination of, your technical abilities and sort of technical expertise that you build up, over time. You do your studies, you get experience as an analyst or whatever. So I mean, the technical core skills need to be there, number one. But then sort of the people element really plays a big part in sort of, I suppose, in any career, right? More so, I think, in investments, because it's so like people really is fundamental to the investment and decision making and sort of the industry. So as you work your way through your career, you build relationships, right? And networks. And that is fundamental to your career journey as well. I mean, the industry, at least in South Africa, is very small. Very, very small. You bump into the same people all the time. You work together certain time, then you go away, do something different, and you find yourself working together again. It happens so often. So relationships are really key. So you need to really hone in on how you manage your relationships and sort of keep that sort of at least cordial, and make sure you don't burn bridges and that sort of thing, which is like really basic career sort of advice. But I mean, I think for me, when you work your way through your career, at least in my sense, where you start off being a technical specialist and then you become sort of a manager of people, that's a whole different skill set entirely. It's good to have subject matter expertise, but now you're dealing with personalities and you have to manage a team, deliverables, but also your individual team members' career growth, things, and you have to, make things possible for them, to reach their goals. And sort of there's a whole different element to it. And you don't really study that, when you're doing your degree or your CFA or whatever like that. You kind of just have to learn on the job. So, and those soft skills really make a big difference in how you progress in your career after, sort of after a certain level. It's about how you get stakeholder buy-in to all your weird and crazy ideas that you want to do. How you position things, how you can network. Like, it's all the soft skills are so important in the investment industry, as it is, I think, in any industry. So it's important that, as analysts, it's not just like a nerdy person crunching numbers there. You need to get out of your bubble and network and speak to people, and that's how your career can really take off.
Yeah, exactly. And also very well done to you and all your accomplishments. I think what you've really highlighted is the value of relationships. My mentor always used to say to me when I went into financial services was that people lend to people ultimately. There's always someone behind the product, and that relationships matter. So
Yeah.
I think you spot on there. I'm going to go straight into the chat and select a few questions. We are pressed for time, so I'm going to ask you to keep the responses short, sweet, straight to the point, so we can get through as much as possible. And I'm so sorry, everyone. I know I stole the time, but I hope you really enjoyed it. This one is for you, Lillian. The property industry is from Amanda Baloi, particularly commercial and office space. How do you see the future of malls in terms of the outlook and expectation of more lifestyle-based properties instead of fully retail? This is around potential returns for investors, I suppose. Yeah.
Yeah, malls are definitely morphing to more lifestyle, experiential entertainment centers, rather than just, a place where you can buy fashion.
Sure.
So it's a place where, and it's not just in South Africa, it's also overseas, where people live in tiny apartments. It's a place where they can go and socialize, meet their friends. It's a place where they can be a bit warm because it's sometimes cold outside, and vice versa in South Africa. It's a bit cooler because of the aircon, etc. So it's a meeting place, and so food there's a big part of the redevelopment. A lot of emphasis is placed on, food courts, etc. For the bigger shopping centres, you'll find there'll be things like bowling alleys, or even, I suppose, it depends where you live these days, but paddle seems to be a big thing. I've seen those now attached onto shopping centres. So, it's less about fashion, because obviously online has made a huge dent in that market. And so you can buy your clothing and your shoes and whatever you need. You don't need a huge game mall shop these days. You can get all that stuff online. So it's more about creating an environment where people want to be and experience things. So that's the future for malls, and it's so far proven to be very a worthwhile exercise. And so malls continue to perform.
Yeah.
Not only in South Africa, but globally.
Yeah, I've also seen the evolution from the traditional versus what we currently have now. It's exciting. And I suppose this one is for you, Faith, from a fixed income perspective. How are you adjusting the possibility of a further interest rate hike by the South? This is from Nkosi.
So yeah, it's been quite a volatile environment. People were pricing in cuts about 2 months ago. So like I said, some of it is you have to think about it ahead of time. By the time the market shifted, which was pretty quickly, we were probably 90% invested. On a forward-looking basis, you're probably filtering out for those who are more exposed to, say, fuel costs or secondary effects from higher fuel costs, so a big reliance on transport or logistics. But in a longer term sense, the portfolios would have had floating rate exposure, because in credit specifically, we try not to take duration. So essentially, the shift happens, but you had already decided that the portfolio construction should not be susceptible to any shocks. And then the sort of selection of assets and the structuring within certain assets, then you would have done it before, but you continue to look for things with, I suppose it's more popularized as margins of safety. So how much, capital do you have underneath to absorb shocks? How much margin do you have? How much extra cash flow above interest payments do you have to absorb the expected, but also, say, further shocks to that business model, and then ultimately to you getting back the money that you've invested. So it's I would say portfolio construction is critical, and then also mitigating against that risk in your structuring abilities when you do lend to those investments.
Thanks, Faye. And last but not least, Wafika. And just before that, I also realized that you've joined us during Eid. So blessed Eid ul Adha to you and whoever else is observing today. You have a question from Sinesi Pomjila. With the current macroeconomic pressure, how should it begin to identify resilient low-risk stocks that can drive meaningful value creation without exposing a new portfolio to high volatility? Is the question.
Okay, so I think this is in the context of sort of a personal share portfolio. So I'll take it in that lens. I mean, I think a key to differentiate is sort of market price versus fair value, right? So if you're doing bottom-up fair value analysis, you're able to identify your resilient type names, your more defensive names. And, you can look at like fundamentally sort of where the revenue drivers are, and sort of how they respond to certain market events, and then you get the actual market price. So sometimes it looks like the share price is rising or falling, and that you can sort of identify if something is underpriced, or rather if the risks already priced into the market price. So you can identify sort of where your your key companies are that are resilient, although the market price might not necessarily be sort of cheap, or it could be expensive. And then that really boils down to your investment horizon. So how long are you going to leave sort of your capital untouched there? So generally in the equity markets, general trend is like, okay, you'd expect over a 5-year view, you get to you'll get value. But in the short term view, you can expect a lot of sort of volatility. So you need to have your own risk appetite, almost like, okay, how much am I going to invest? Hopefully it's not too big of your own personal savings that you allocate to shares, and that you also leave it untouched for a while, so that you can withstand the volatility and it won't hurt you financially in terms of your normal day-to-day. And then if you're comfortable with the asset class, and then you can find your top picks based on where you think the resilient sectors are.
Oh, perfect. And one last one, any taker on this one? Very quickly, how does a company's reset after a black swan event like COVID from a value creation perspective? I think you sort of touched on it, Lillian, when you were just going through your journey. Perhaps maybe this one is for you. And then we'll round up to a close.
The reset, I think it boils down to the fundamentals, the work that you've done, the ground up stuff, and the beliefs that you have that your work is proper. And that will see you through, because eventually the market wakes up and realizes, oh, this company isn't going to fall apart. It is still around. It's got good growth prospects, and eventually the repricing happens. You just have to, see yourself through that moment. And it's hard because, you might have clients that come and question you and say, well, what are you doing holding the share? And you have to have conviction around your decisions. But if you've done the groundwork and you've done it properly, then eventually, and they've got a long time horizon, you should see the fruits of that. But I have to say, our experience was never in my life. It was a very difficult period, and amazing to see that you can get through it all, and it is just that hard work. There's no getting away from that. So yeah, and if I may, it's about the people that you work with again, the team. Like Wafika was saying, absolutely, that management style is so critical, because, if you know I've got to take your eye off the ball and find replacements, it's very difficult. So it's good leadership. Well, I'm looking at Wafika and listening to you, nodding my head. That's key as well. So, and the other point I would like to raise is take the time. When COVID came, there was an impact course that was run, and it was an international course, and it was amazing. And what a wonderful, it's hard to find the time now to do that. But ladies, if there's any opportunity out there, even if it's short term, short courses, do them. And the networking is so critical as well. And all of those things, because there may well be another black swan event, but all of those things will pull you through. No doubt about that.
Absolutely. And then as your final parting shot, one word. We know the current state of the global investment climate is fueled with uncertainty, and my words I'd like to use is critical but stable, but you only get one word. If you had to describe in one word what you hope for the future is, what would that be as a parting shot? I'll start off with you, Wafika.
My goodness. So the question is in one word?
Just describe in one word what your hope for the future is.
Oh my goodness.
Should we go to Faith and give you time?
Yeah, thanks.
I think my one word is inclusion. I think there's just so much opportunity, and that is out there, and I'm hopeful that technology helps us to bridge that divide. In terms of parts of the market, say where finance hasn't got to, makes access easier, provides resources where they need to go. And I think ultimately if we do that, then I think, to borrow a word that's been used a lot, we'll become more resilient. essentially.
Resilience. Yeah. Wafika?
What's going to be my
Back to you.
word? I was going to
Yeah.
promise. I was going to say resilience. So basically, the world can throw anything at you, and you need to be able to, to withstand that. See how you can wiggle your way through anything, and just basically be resilient for whatever comes your way. Yeah.
Absolutely. And you, Lillian?
So my
Closing
word
remarks?
is an extension a little on what Faith is saying. I want to see peace in our world, peace in our land, and with that will come prosperity for all.
Oh, ladies, you've been amazing. Thank you so much for those great insights. I think the comment section is also in agreement. I see Faith also has a fan base, Nomsa Sibanda, saying, yes, fabulous Faith. I think you've been absolutely phenomenal. Thank you so much. And to everyone that's attended and stayed thus far, thank you very much for all your available insights, as well as what is the questions that were posed in terms of this conversation. Please don't feel like this is the end. I think from an AWIF perspective, we always want to do this kind of webinars. So please watch that down. If you follow us on LinkedIn, thank you very much. If you don't, we're ABSIP Women in Focus on LinkedIn, and then on Instagram, we're ABSIP_WIF. From me to you, wishing you peace, love, and happiness, and to those observing Eid, blessed Eid, everybody, and good night, and God bless you. Thank you so much.
Good night.
Thanks for having us.